Pleasure to welcome upon stage. We've come to a very exciting part of the day, and I really don't want to unravel and unveil what we are going to be doing here. I would like to invite upon stage Sandeep Sinha. Sandeep is Sandeep is the board member of TIE Delhi-NCR, and Sandeep is also co-founder of Oister Global, co-founder and managing partner at Lumis Partners. I will just simply hand it over to Sandeep and leave you all with him. Over to you, Sandeep.
Thank you so much, Upasana. So good evening, everyone. So the final session before the round of cocktails begins, so we'll try and keep it as brief as possible. I think we've all been talking about private market, the startup ecosystem since this morning. About 350,000 startups, the third largest entrepreneurial ecosystem in the world, and gaining more and more prominence literally on an exponential basis, on an everyday basis. And I think that's the power we are all here to witness. And we at Oister, we are a private market asset manager. We work with the top fund GPs to co-create products which are the leading private market opportunities in the country. And as a part of that, we get a chance to kind of evaluate the fund managers across the country. And what we have seen is in the last 10 odd years, the market has seen tremendous amount of maturity. We have almost about 300 plus fund managers across the country today. And across these 300 plus fund franchisee, there are about 66 GPs who are on their third fund. The remaining 234 GPs are in their first fund or the second fund. And the reason the session today is very interesting is that we gave a very in-depth look to about these 234 GPs across the country and diligenced, looked at the numbers from multiple parameters, looked at their performances from across the board and so on. And finally picked two of the GPs who have the absolute stellar performance based on what they have done up till now, and the kind of work that we foresee them going forward, which is the part of the GP spotlight for the event this evening. With that, I would like to welcome the two GPs who are in town today. We have Nitin from Filter, and we have Sheetal from Merak. Please give them a big round of applause. I have a few questions lined up for them, and then after that, you guys are most welcome to ask them any tough question that you feel like throwing at them. So thanks again, Nitin and Sheetal, for being here.
Thank you for having us.
Why don't I start with the easy part of the conversation, which is about the fundraising. And given the fact that both of you guys have been raising fund recently, where the listed market has done an absolute stellar job of killing the performance, how has the journey been trying to convince people to stay away from a top performing listed market in the country and instead invest in a 10-year fully committed product which is not going to be liquid for a while? So Nitin, you want to start from there?
Jump right into that. The easiest question first. Well, look, thank you very much for taking the time. I mean, it's the last session, but folks are here to listen to Sheetal and I being grilled by Sandeep. And we are a first-time fund, Filter Capital. We focus on growth stage investing in tech companies. We're a Cat 2 AIF. We've raised primarily from domestic capital. We have some foreign investors as well. So given a majority of our capital is from domestic investors, I think the question that you ask is actually quite relevant. When you raise money from foreign investors, they say, why do we invest in India? We can just invest in the US, and the US has been giving great returns, both public and private. But when you're raising money from domestic investors, they do ask the question, how do we consider you relative to the public markets? And I think there are kind of two or three things that worked in our favor. The first is, I would say that there was already, we invest in tech companies. And if you look at the representation of tech companies in the stock markets in India today, other than IT services, actually the representation is quite low. If you look at the Magnificent Seven out of the, it's like a majority of the S&P value. But there was a general recognition that if you wanted to participate in tech risk reward, then you were actually not going to get it into the public markets until actually very recently, since 2021, all these companies listed. And even then, the perception was, yeah, but by the time all these VC-backed companies listing in the public markets, the juice has been squeezed out of that lemon. So we really need to go earlier in the cap table if we want to take advantage of very attractive risk reward in the tech startup ecosystem. So that was number one, this idea that tech itself might be underrepresented in the public markets. That really worked well for us. The second theme was, which was actually quite helpful, is that there were enough folks in the ecosystem who had actually made money investing in startups, right? Think of all the family offices who made money investing in Nykaa, and there are so many other companies that have listed during that period of time. That's actually worked very well for folks being saying, okay, we've made money in this asset class, and because we've made money in the asset class, we're ready to do more. That was number two. I think the third was just a broader concept of diversification, and also the emergence of institutional allocators, such as Oister, of course, Government of India, SIDBI, SRI, recognizing that there is a requirement and an opportunity to invest and earn good returns in the private capital ecosystem. Many of them are investors in our fund, and we were privileged that there was already that mindset that we are interested in supporting new managers in private capital, and that helped us as well.
Super, that's very helpful. Sheetal, you want to share your perspective?
Yeah, sure. Thanks. Thank you for having us here. Nitin gave you a response which makes it sound like all these people were completely bought in. That was not the case with us at all. I think fundraising is the toughest part of running a fund, and it takes forever to raise each one. The last couple of years have not been a great market. We announced this in September of 2022. Markets were rallying, there were things going wrong, et cetera, et cetera. So we had an uphill battle to fight. Who were we able to raise from, and why were we able to raise? So just quick context is that I run a seed stage B2B emerging markets fund. This is my second fund. I've been investing in this thesis for a while now. In the previous fund, as well as in this fund, we have about 2/3 international money, 1/3 domestic money. So why were people still investing? 3 or 4 reasons. One is, I think, we have a very sharp positioning in terms of what we do, and we've stuck to that positioning for the last 8 years, which is B2B deep tech. That helped us because a lot of people have more generic funds in their portfolio right now. So if they were willing to take 1 or 2 more bets, they were looking for potentially specialization, and especially some investors who wanted some deep tech exposure. Another reason was that we now had a few years of track record, and fortunately our syndicate portfolio as well as my previous fund portfolio, they've done well. Third was there were just new pools of capital which I think didn't have exposure at all. So I think it was easier from 1, the new pool, and 2, from the very mature pool. The very mature pool understands that this is a really long game. You need to diversify, you need to have public markets, but you also need to have private markets, so they will keep a mix. And then there's this brand new money which is coming in from industrial families from all parts of India which have not yet taken exposure to this. We have money from Raipur and Ranchi and Raebareli, and other smaller towns, which is not something that you would typically expect. So there were these new pools of capital which came in. So this is how we cobbled together whatever we did.
Thanks, Sheetal. So I think just right outside we were talking about the effort it takes to actually raise capital. And I was telling them that you guys are the new GPs on the ground, and Nitin said, I have white hair, and Sheetal said, I've even lost what I had. So talk about the journey, about the capital raising, which has taken its own toll. We've named this, and somebody on the team named this session as the butterfly effect. So before coming on the stage, I was quickly Googling it to figure out what the hell is a butterfly effect. And I realized that the small changes, which make a big difference over a period of time. So given the fact that, you guys are the new incumbents, right? You are trying to redefine the world of investing in some sense. Though you come from a very conventional background, Nitin, you've always been an entrepreneur GP by yourself. What are the things that you're seeing different in the way the rules are being redefined, for the new age investors?
I'll go first. So I'm going to draw an analogy which I think everybody here will be able to understand fairly easily because of their investments. So think about this a little bit like investing in startups versus investing in big tech, right? You have money which you allocate for Google, Amazon, etc., but you've all invested in early stage startups too. Why do you do that? It's the question we'll all often ask is that, hey, why can't just Google build this? They have all the resources, everything, etc. in the world. So we have tons of VCs in India who've been, not tons, well, a dozen at least, who've been here for a long time, who have pedigree, who have track records, etc. And there is a newer crop like us. We have the same kind of advantages and disadvantages that a startup versus a big tech company does, right? We possibly bring in a fresh perspective while they might have a set perspective. We are nimble, we can move much faster. They are set in their ways. We have a greater risk-taking appetite at this point. We do lots of spaces which, more seasoned funds might not be doing, right? So if you look at this now, newest, let's say last 1 or 2 years of investors and fund managers, you'll see so many of them are now doing deep tech. All of them are not really deep tech investors, but well, to some extent, yes. But a bunch of them, for example, are doing deep tech, and they're doing specialized stuff, right? They're also part of the maturation of the system also leads to the ability that people can do more nuanced thesis and more specific thesis, right? So again, while earlier funds have broad thesis, now there are lots of funds who are doing very, very specific stuff. Yeah, so I think that's some of the things which are happening differently. So you'll see a bunch of funds who are more specialized, who are more nuanced, who are willing to get involved, who right now startups can get partner attention from, which might not happen in larger funds, who take different kinds of bets.
So Nitin, in your case, you come with a blue chip investment background, coming in from Warburg Pincus, fabulous background before that. So I'm sure when you would have started, everybody would be you just hit the ground and you'll have the first $100 million your way. How was that being able to explain to people with a new brand and kind of create your own space to say, you know what, invest in me?
It was really hard. The journey of a first-time fund manager is always painful, and I think that to the earlier point that was raised, and even with your earlier question, there had to be a little bit of this reason to exist. Like, what was our reason to exist? Why did filter capital deserve to exist? And it's almost not even a right to win; it's a right to exist, because ultimately we're managing others' money. And we had identified this opportunity while we were at our prior firms. I was at Warburg Pincus for many years. My partner worked with me at Warburg Pincus, and then he led. We were doing tech investing for them, and then he led tech investing for multiples. And I said, let's get together and let's focus on building a leading growth stage tech investing firm out of India. We had known that this is an independent asset class in markets like the U.S. There are many tech-focused private equity firms in the U.S., whether it's Insight or Vista, TCV, Thoma Bravo. We know that was playing out in China. There are players like Hill House and Genesis that have built multi-billion-dollar franchises. And we said, there's an opportunity to build such a franchise in India as well. And we had specifically identified a stage where we thought would be the right entry point for this strategy. We are actually Series B and Series C investors. And our hypothesis was that, by the time they get to Series B, typically 8 to 10 million of revenues, there's enough of data that you can arrive at a point of view on what is the potential of this business. Do they have the ability to get to $100 million from $10 million? The business is somewhat de-risked because, you have a statistically significant number of customers who can say, yes, I use this product or service and I get ROI from it. And then it's a call that they can scale. But we were finding that the early stage venture ecosystem was really unable to lead Series B and Series C rounds except for a handful, and we can talk about them later. And late stage firms were not really interested in writing small checks, And hedge funds were kind of here today, gone tomorrow, and today they're not around, whereas a few years ago they were. And family offices would say, well, we need someone to lead this. So we found this interesting situation where if you were an entrepreneur raising a Series B or Series C round, you would meet everybody because no one had a mandate to invest or lead your growth stage round. And that, we said, actually creates an opportunity and a right for us to exist. And we were actually not the only firms who came up with this. There are a handful of other firms, actually over the last 2 or 3 years, many of whom you would have met, who had said, you know, there's this opportunity in growth stage tech investing. But what's unique about us was we were the only team where 2 partners who worked together, who led tech investing at a private equity fund, actually had a great track record and are doing the exact same thing at their new venture. We're not LPs becoming GPs, we're not operators becoming investors, we're not late stage guys becoming early stage guys, and we're not early stage guys becoming growth stage guys. We were very particular about this is what we've done and this is all we will do. And some of that stuff starts resonating. And I think that's one, if I were to think about what has worked well for us, and many things did not, which we can also talk about, but what worked well for us is being very clear about what our strategy was and what our reason for existence was, because then you have to pitch and pitch and pitch. You would have met 500 investors. I probably met 500 investors. And you have to have very thick skin, and just like many entrepreneurs do, and you just have to roll with it. You have to be that convinced. And then at some point in time, the persistence begins to pay off, and the tide starts moving in your direction. But it's been an incredible journey.
No, that's absolutely true. And I think if you look at, we keep talking about to entrepreneurs about the underserved market. And I think in the world of investment, growth stage has been a genuinely underserved segment. Sheetal, how about the other side of the equation? Once you've raised capital and you're out there to deploy, the challenge is that, when you want to give your money away, which seems to be a relatively good task to do, saying that, okay, I'm just in the business of giving money. Entrepreneurs are equally choosy, right? And when you come across, I'm sure, like a top-tier entrepreneur who was a choice to pick from a global brand operating out of India with $3 to $4 billion of dry capital, dry powder available to them, versus some of the entrepreneurs who will be genuinely saying, who is Merak, right? So how does it work? I mean, like...
actually, this is the much easier part. You'd be surprised by how easy it is to compete with the really big names when it comes to investors making choices. Why do they choose us over others, right? We have a playbook. We have been doing seed stage B2B deep tech investing since 2016. We were amongst the first guys to do this. We found tremendous success. In our angel syndicate, we've done 8 full meaningful exits out of 23 companies. Our previous fund is sitting on a MOIC of over 5 in less than 5 years. And we've got a lot of these deep tech successes, right? We've helped open up a bunch of new industries, space tech, genomics, robotics, semiconductors, etc. So there is this whole group of entrepreneurs who will come in and say, hey, we know you've done this and you have a playbook for this. We would love to have you on our cap table. We're doing a space tech investment, which we'll announce soon, and I'm doing one after over 5 years. These guys had their round stitched together, but they got introduced to us and they said, there are 2 firms in India, but we will wait for, and we will change our round construct for, and we were one of them, and there's another prolific space tech investor. So one is that, right? That you don't have a your $1 billion fund, but you have a pedigree in a specific area. 2 is that they also realize that they can actually get a lot more help from us in many ways, right? We're a small fund. You will get partner attention. You're not going to get partner attention necessarily from a $1 billion fund. We will be able to spend a lot more time with you. We are much closer to what you're doing. So they find that value addition meaningful. And for example, we work in 2-3 different ways. We'll always help them in strategic planning. We help in business development and fundraising. And these 3 things we're super active on. A third reason is why they would pick up smaller names versus big names. And this is really interesting because many people have asked me this question. So people have said, why would somebody pick Merak over a Sequoia Surge or an Axel Atoms? And also upstream, maybe angel syndicates, etc. The people we lose our deals to, by the way, are only angel syndicates where there are angel leads who are even more involved than we are. We almost never lose out a deal to a Surge or an Atoms. And there are multiple reasons. One is we know our 0 to 1 journey of founders really well, right? They know some of the 1 to 10 and they know the 10 to 100 really well, but they really don't know the 0 to 1. For example, if you're a firm who's raised $50 million, you're not necessarily worried about raising, running out of cash. If you're a firm which has just raised 5 crores, you're always worried about running out of cash. You have to run these companies differently. You have to plan their business differently. You're always looking at the next round of funding. So we know the 0 to 1 journey well. 2 is there is massive negative signaling, Sandeep, if a late stage firm comes in and takes small bets and then doesn't follow up. And I've given this example often. There's a fund close to 100 million which had these starter checks of 1.5 crores, 10 checks of 1.5 crores, right? 9 out of those 10 did not raise follow-on funding from them, and 8 out of those 9 died consequently because of the negative signaling from the fact that the fund hadn't followed up on that, right? It's a real issue, and that's not a risk founders want to take. They understand that in a 700 crore fund, a 1.5 crore check from that fund is a meaningless one, and they know they're just creating an option value for themselves and don't really care beyond that. So that's how some of the stuff works in our favor.
You want to add to that?
We see the same thing in the larger scale. We see situations where if we're competing, and we're an 800 crore fund, and we do Series B and Series C rounds, we'll look at services, IT services companies, software companies, consumer brands, some fintech and B2B. We might compete with any large cap VC firm that has a growth sleeve, and we all know who those folks are. We find that those funds are so large, they are effectively playing venture with a larger check. It's the same venture risk reward. They are distributing their investments across a larger corpus. They still need everyone to return the fund, but now the fund is a $600 million fund. It's not a $200 million fund. And as a result, you either start A, encouraging the entrepreneur to take more risk. B, you're more valuation insensitive because, if it works, it'll return the fund. If it doesn't work, it doesn't matter. C, if it's not working quickly, you might even stop showing up to the board. You'll depute some junior guy to the board. And so as a result, the entrepreneurs will then say, okay, is that the alignment I'm looking for my next financial partner? And if entrepreneurs are, we see it in situations where the entrepreneur will say, hey, we're increasing the round size. Instead of a $20 million round, it's going to be a $40 million round. And then suddenly we're like, okay, now the entrepreneur wants to, take a bigger risk. And then we say, okay, maybe there isn't much alignment between how we think the entrepreneur should be building the business and what the entrepreneur actually wants to build. As a result of which we don't find ourselves competing with those kinds of firms very often. We find ourselves competing with mid-cap private equity firms who tend to be generalists and are dipping their toe in the water in tech. And there we can tell the entrepreneur, look, we've been there and we've done that. We know how to handle losses. We know how to think about path to break even. We're not going to push you to become profitable. We want you to do value creative things, but we're not going to push you to become profitable for the sake of becoming profitable. And some of that experience and referenceability helps when we're competing against kind of that category of investors. And those investors are making enough money looking at NBFCs, profitable businesses. There's so much growth, as we all know, that they don't actually necessarily need to focus on that asset class, which then creates a little bit of a niche for us in this kind of tech-focused mid-cap private equity space where we play.
And when you look at the portfolio, Nitin, what is the loss ratio or the dispersion that you look about? Because one of the conventional feelings is that, okay, even if you lose out a few, it doesn't matter to you.
If you look at our prior track record from our time at Warburg and Sumit's time at Multiples, we had invested, I think, $300 million across 6 companies. The last time I checked, that portfolio had generated a high 20s dollar IRR. There was one partial impairment where we took some money out. We didn't recover our cost, but we had to take a partial write-off. When we constructed the portfolio for Fund 1, our view was 8 to 9 companies. Every company should return capital. And if we have to live with an impairment, let it be a partial impairment. If we have to suffer a write-off, the fund returns and economics don't work for us and don't work for our investors. And as a result, we tend to be a little bit more focused, therefore, on what types of industries, what types of, the sector dynamics need to be well understood, because we can't take certain kinds of risk. We would need 25 companies in our portfolio in order to be able to take that risk. But we also recognize that we're not pricing our deals at 10 times our money in the base case either, right? Because if you're going to live, if you don't want the mortality risk, you have to be a little bit more cognizant of your base case risk, which in our view should be in the 4 to 6 times in our base case.
Sheetal, your spectrum is a very different side.
Yeah.
So how would I ask you, if you can share some journey with an entrepreneur who the highest end of the risk, the youngest end of the entrepreneur, something crazy that you have done which hopefully has kind of played out okay.
Yeah, sure. One of my favorite stories, and this is actually very topical also, there's a company called Pixel, which just recently became the first private sector company to set up a commercial satellite constellation. This happened on 15th of Jan when 3 of their satellites went up in space on a SpaceX rocket. They are trying to create a constellation of hyperspectral imaging satellites, highest resolution, smallest size, and they'll set up about 25 of these geosynchronous over the next few years and basically supply kinds of images and data which have not been, which we've not been able to see so far. I think these guys are amazing founders, and we met them when they were in college. So there was a small event by some policy think tank, and I was sitting at a table, they were sitting on this next table, they came up and said hi, and I said, we had a quick conversation, and I thought they were very interesting. I said, are you here tomorrow morning? They said, yeah, we have to go to college, we have exams, but I said, could we have breakfast? So we had breakfast at Blue Door Cafe in Khan Market. They went off for the exams. By the end of that, I told everybody in my team that, I asked them to come back on Saturday, and I told my team, Saturday evening, whatever you guys are doing, you have to cancel your plans, and you have to meet these guys, because we have to invest them. This is the first, only time that we had ever we said on the spot yes to somebody. They came in, presented, so these are two 20-year-old guys, right? And they give us a very nice roadmap saying, here we are in 2019, this is what we want to do in 25, this is what we do in 30. By 2040, we want to be on Mars. By 2050, we want to be doing asteroid mining. Or some such completely ludicrous stuff. But it sounded completely plausible when they were saying it. We were completely buying into the story. And remember, this is when space tech was not a thing, right? So I started evaluating space tech in 2017 when it was not a term. In Jan 18 is when I gave my first term sheet in space tech. Our LPs were beginning to wonder, what are you guys doing? But we had a thesis. We knew this could play out. These guys have since then gone on to raise, they're the poster boys of India's space tech now. When this constellation went up, the PM not only tweeted about it, but the last Mann Ki Baat a few days ago, he opened with our space tech story and opened with the Pixel story. He absolutely loves this company. They have since then gone on to, raise money from GIC, MNG Catalyst, Google, Lightspeed, Bloom, Omnivore, a gazillion different funds. They managed to put up 3 demo satellites first, which have all been retired. First satellite in $1-digit million in under 3 years in space, which got them space qualified. Now the first production constellation is up, and they still continue to blow our mind.
Amazing. Yeah. Brilliant story. I mean, to think about investing in college kids with a 25, 30-year game plan, I think that's astonishing. Nitin, how about from your side? I think you've been working with some of the most fabulous entrepreneurs. Any interesting anecdote where you have actually joined hands with an entrepreneur in terms of building out the business, being fairly actively involved?
Yeah, there was, one investment that we had made when we were at Warburg, which we then doubled down on at Filter, our portfolio company, Capillary Technologies. And it's an enterprise software company that sells to large consumer-facing businesses, retailers, airlines, hotels, to help run their loyalty program. So it's a software stack that runs loyalty. And it's an interesting journey because they actually did not go to the US on day one. Many SaaS companies, the founder will leave for the US literally after the seed round, and they'll focus only on building in the US for US customers. The idea of a software company starting in Asia and then building for the US market was actually relatively less well known. In fact, the only story you would have even heard of was iFlex, which was bought by Oracle, that core banking software company that pretty much every bank in emerging markets runs on. And Capillary had gone, kind of grew modestly over a period of time. They had tried to launch in the US a number of times. In fact, one time in 2015, they went and one of their co-founders decided to stay in the US, leave the company, and build his family there, which was a loss to the company. But ultimately, it's hard to scale in the US, but they had built a really interesting business in Asia. And in 2021, literally recovering from COVID, they had identified a really interesting growth strategy in the US, which I think is a very unique playbook that many Indian software companies could use. It just so happens that the industry that they were operating in, which is loyalty, was the purview of services companies in the US. So a loyalty program in the US is probably managed by some 20-year-old custom developed software and run by marketing agencies. And if the custom software development hadn't been updated or upgraded, it wasn't going to be, you couldn't query it for, what are my customers actually doing and can you ingest data in real time and tell me what they're doing? No, you send a ticket and they'll get back to you. Or if you wanted to amend the terms of your loyalty program in real time, send a ticket and they'll get back to you. These agencies couldn't do this in real time, and Capillary said, well, we've been doing it in real time for our large enterprise customers in Asia. Why don't we acquire the services companies and then migrate their customers to our platform? And this has worked incredibly well for them. And it's a function of the fact that, as we know, the services story out of India has been just tremendous. But here's this product story out of India, which is somewhat different from other product stories you're hearing out of India. The idea that you could acquire these US services companies, migrate their customers to a cloud-based, multi-tenant, kind of Gartner and Forrester approved software stack, and then actually run the software, the implementation, the account management, the customer success, all out of India. They've made 3 such acquisitions. And then on the back of those acquisitions, because now they have Hertz and they have Dell and Santander Bank as customers, they won organically one of the largest contracts any SaaS company in India has won in the US, full stop.
Wow.
So the story has just been tremendous, and hopefully, I think that the company can now continue to build it. They're getting invited. This is really interesting. They're now getting invited to the Delta Airlines RFP or the IHG RFP, right, which is Intercontinental Hotels. They won't win those immediately because they've only been in the US for so long. But the fact that they're getting called suggests that the opportunity for them is tremendous. And as investors, of course, that's what makes us so excited to be a part of these journeys. In this case, first at my prior firm, and then now at Filter.
No, absolutely fascinating story. In fact, Capillary is one of the companies which has received the award from TiE Lumis side.
That's
yes,
right.
So, long
You
association. Long association with the firm. But before we take this forward, any questions, guys, from the floor? Anything that you would like to ask, guys, here?
I think I'd like to ask you, Sheetal, you were talking about, thank you. Lovely conversation so far, but Sheetal, I had a question for you. So you were talking about how you have an advantage and a disadvantage of being a smaller fund, a newer breed of fund managers, right? But do you also think that eventually, obviously you're not in the business to do just one fund and you'd like to come with more and more in the future as well. Do you think eventually, since you have a niche and you have a focus and you have an entry point where probably the mouth of the filter is not very large, you'll face problems in identifying opportunities to invest in?
No, I think in what we do, first, the number of startups just year on year is exponentially growing, right? The problems in the world to be solved are far from being solved. So there are a ton of use cases. And every new technology brings with it changes, right? Gen AI has upended our world over the last couple of years. A whole bunch of companies will shut down because of that. One of my angel portfolio companies which was $15 million ARR, is going to shut down just because of Gen AI. But they'll also create a whole bunch of new opportunities for us to be able to invest in. So I don't think we are anywhere, at any point, going to be at a place where we are out of ideas to invest in. You know, that's part of the reason I don't feel any FOMO at all, and don't ever regret missing out on something, because you know I believe there will be something great 5 or 10 years down the line. You talked about whether there'll be enough opportunities, but before that you had started talking about something else. Was there another part to your question?
I think just the fact that, you know, if you're focusing on a particular sector or a particular niche, no matter how wide or narrow that niche could be, does that create an opportunity, or eventually it can also become a hindrance because you've not actually prepared yourself to be slightly more broad-based than a more generic fund is?
That's a fair point. I think it's the nuance there is how niche are you going, right? So if I were to say I'm a space tech only fund, it could be a problem. Oh, by the way, as an aside, I have a thesis. If anybody's buying into this, please let me know. I think there is a very strong case for a 12 to 15 year long Series A to C space tech only fund, and I'm happy to run it in parallel to Merak. I'm absolutely convinced that some mind-blowing stuff is going to happen there. But you know, that's a contrarian example. But if you're looking at, for example, I do deep tech, right? I look at the emerging tech part of a portfolio. There are a gazillion different new technologies which will keep coming on, and no deep tech technology is necessarily comparable to another one. So robotics does not help me with semiconductors, which does not help me with electric vehicles, which does not help me with genomics. I think that's a really wide enough canvas to play. I might worry about it if I say, I'm going to be a genomics only fund, but I'm not worried right now.
I think it's an interesting question more generally, which is, if one of our value propositions as small and emerging managers is that we know how to compete with the big guys, what happens when we become big? And then will we still be able to communicate the same value proposition? The way we've thought about it is, for every deal, so far in our first fund, every deal we have done, we probably could have bought more in the company. So if we had been a 1,600 crore fund instead of an 800 crore fund, we would have deployed $20 million in every deal instead of $10 million in every deal. So we found that the opportunity we had identified should support us for Fund 1 and Fund 2, at least, without having to change anything we do. Because we understand the dynamics of company may need capital, but early investors also need to exit because they have to return capital and recycle. So there's always a secondary opportunity by the time you get to Series B and Series C. Why? Because the companies are already 8, 9, 10 years old by the time they get to us, but they're still 5 to 7 years away from the public markets. So there's an opportunity for us to simply do more even if we were double the size. I think that when we get to Fund 3, let's say hypothetically, if all goes well and we're a $400 million fund, at that point in time, I would kind of rely on Sheetal's point that the startup ecosystem itself continues to grow. And so the sweet spot for us are Series B and Series C rounds where we think that risk reward is somewhat attractive and opportunities are underserved. But that will also migrate over a period of time as the opportunity continues to scale, and new funds will emerge. When we vacate a certain space, I think new funds will emerge and take our place.
I want to make just one point which is related to what you started with and what you also started with about when you set up Fund 2 and Fund 3, etc. This is a contrarian point, and hence I want to mention it. We believe venture capital does not scale at all. Our first fund was subscale because we were first-time fund managers. That's all we were able to raise. This time our intent is to raise about a $75–80 million fund, 18 to 20 company portfolio, pre-seed and seed stage. My partner Manu and I have discussed this many times and said, are we going to go to like a $150 million fund next time? No, we won't know how to return the fund. I think adjusted for inflation, maybe the next fund could be 90 million, maybe 100 million, maybe the next one after that could be 120 million. But we are not going as a seed stage fund from, and this has happened in the new ecosystem, people who their first funds were in the few tens of millions of dollars and fourth funds are in the few hundreds of millions of dollars. Those economics just don't work. You cannot return a multi-$100 million seed stage fund. You could return a multi-$100 million CDC fund. There is no way you can do that at seed stage. So I think venture capital doesn't scale.
How do you think about I'm sorry, I'm just jumping in. How do you think about many of the arguments they make is, we have to reserve for follow-ons, or we left too many chips on the table, or LPs are saying, if you had held them longer or acquired ownership interests for a longer period of time?
So one, I'm sure you face this the way I face this, which is, and almost every LP we have spoken to today wants to see DPI before anything else, right? So you just have to be now really disciplined about exits. We have a very, very clear mandate that, by Series B, we'll start trying to exit. By Series C, we should ideally have exited most, if not all. By Series D, we should be 100% out. Don't stay with the temptation to stay in for multiple reasons. One, this is our place in the ecosystem. When I decide to do a follow-on in a Series C, I'm effectively taking a Series C decision which I'm not equipped to take, which you are equipped to take. I make gut-based decisions. I invest in companies when they're at an idea stage and talking about asteroid mining in 2050. I have no numbers to look at all, right? But Series C is a numbers-based decision. So I think this is my place in the ecosystem. And third, I don't think exits are available all the time. I exited a company in 2021 where I made a 41 exit because it was a ridiculous market, 2021, if you remember. Everybody was valuing companies at preposterous amounts.
People are still recovering.
Yes, yeah. That company is going to get sold very soon for less than half the value at which we exited. Twice the size of what it was when we exited. Because it was just the right time to do it. So just have to be disciplined about it.
So you touched upon an important part about the DPI. So I'm going to hit you with that. So I think we have David Wilton, who is our Chief Investment Officer, and right from the day one, he's been talking about the value of DPI, actually returning capital to investors and not necessarily having IRR on paper. So how obsessive, this is probably my last question and then we'll bring it to a close, but how obsessive are you guys about DPI and insistence on saying, we got to take chips off the table versus someone saying, you know what, I love my investment so much that I'll forever stay invested and keep rolling it in one shape or form to the other and so on.
It's interesting you asked this question because a few panels ago, there was a completely different point where there was somebody, a family office or a promoter basically said, I don't want the money back. I want to have to pay taxes on it. I have to figure out where to put it next. The long-term compounders, had I come into Infosys or HDFC Bank 20 years ago, my gosh, I wouldn't have to work anymore. We can anyway. But I think that it's very important to be focused on DPI as a private market investor because liquidity is simply not available on tap. And because it is not available on tap, you have to take liquidity when you can get it. I think that as a public markets investor, because you have that liquidity available whenever you want, you can kind of play it out as long as you want, but private markets become hard. And given our backgrounds in private equity, we were just raised to think about it that way. And it wasn't just Warburg. Even my partner would tell the story about Multiple's investment in Dream 11, where they came in at, I think, $23 million investment at $110 million pre. That investment returned in all of Multiple's Fund 2. And that was not even the only investment that returned all of Fund 2 for Multiples, but $550 million outcome. And Multiples sold in tranches before the early stage VCs did. In fact, some of them have not sold. So that mindset, the private equity mindset of you just take the money when you can get it, it's just institutionally driven in our industry, and we're hopeful that we can inculcate that kind of thinking in our asset class as well. And we're not under pressure for every deal has to be able to return the fund. That's not the mindset. The mindset is every deal must work, and we're going to be judged on our ability to drive outcomes across our portfolio as opposed to simply having one or two winners return the fund. And that, again, then creates that discipline on our end.
Same for you, Sheetal?
I'll just reiterate what I just said. Absolutely obsessive about and disciplined about exiting. Our intent is every investment of ours, we should exit in a 5-6 year time frame. Series B, Series C, max Series D. Or if earlier, if there's an opportunity to be able to do it, if it's a good multiple, if the market timing is right, if it seems like a unfairly good offer, we would exit. So I'm of that school. I know there are fund managers. I have a friend at one of the earliest venture funds in India who never wants to exit anything of his portfolio. He had a 10-year fund and he's taken 4 extensions right now because he keeps saying, at this scale, even if that grows like 30% year on year, it's fabulous. And he once told me, pick any building in Nariman Point and I can buy it off from my first fund. And that's only because I've extended like 3 or 4 times. We just stick to being very disciplined about exiting early.
Perfect. Thank you, gentlemen, for being here today. And just for the audience, again, like I was saying in the beginning of the conversation, about 300 plus fund managers across the country, about 234 funds, which are in the first or the second funds. And from there, with all the work that we did, we picked the 2 GP spotlights for this evening. And I would request our CIO, David Wilton, to come in and give the first award to Sheetal. And I would request my colleague Rohit from Oister Global to give the second award to Nitin.
Congratulations. Come, Sandeep, join. Super.
So maybe just one, all 4 of us. Come.
Sure. Yeah. Here's your award. Hold it. I have to hold the award also.
Yeah. Thank you once again, everyone, for being here this evening. Upasana, back to you.
Thank you very much, Sandeep. Congratulations, Nitin. Congratulations, Sheetal. This is absolutely fabulous. Thank you, everyone, for being here today. I think it was a great effort that all of you made to put all this together. Many thanks. And we will be in touch. We will wait to hear from you, have your feedback. We will be sharing a brief feedback form. It'll be a little bit of an effort for all of you, but it'll be lovely to have your feedback because we want to build what we have here today. All your efforts, we want it to come together as we go forward. And now we are open for a brief sort of networking and drinks evening here. Look forward to having you all, talking to you all in better sort of depth that I have not been able to spend time all day. But thank you again, and congratulations to all of you. Thank you once again.